afternoon to all of you. Let me have the pleasure of welcoming all invitees gathered here today for this special lecture to be delivered by Professor Grant Spencer, former Deputy Governor of the Reserve Bank of New Zealand, on key elements of a market-based financial system. Today we have a prestigious audience representing senior professionals of the financial industry in Sri Lanka. We are so glad that all of you are here with us today. Moving forward, without taking much time, let me now invite Dr. Nandalal Veerasinghe, Governor of Central Bank of Sri Lanka, to deliver opening remarks and also to introduce Professor Spencer to the audience. Audience now.
Good afternoon, Professor Grant Spencer, the Professor of the University and former acting governor of the Reserve Bank of New Zealand. Your Excellency, Michael Appleton, High Commissioner of New Zealand, Sri Lanka, Mr. Andrew Travel and Good Health Commissioner, the distinguished guest invitees, and my colleagues in Central Bank. Today, in fact, we are extremely privileged to have Professor Spencer to give a lecture on the important topic, which is key elements of a market-based financial system. A very timely topic for Sri Lanka as well as many other regional economies, given the developments in the global financial markets and swift changes in the monetary policy making. Of course, we had the privilege of having Professor Spencer earlier on a virtual basis, I think a couple of months ago. So on that basis, we invited him here in person, and I'd like to thank uh, High Commissioner of New Zealand for supporting his presence here. Uh, as you may be aware, we have both market-based as well as bank-based financial systems. Depending upon the way funds are raised in the economy, a system that relies heavily on selling securities in the open market is a market-based system, and a financial system in which investors invest their money in banks is called a bank-based financial system. For over a century, economists and policymakers have debated the relative merits of bank-based versus market-based financial systems. Thus, there have been competing views on the policy debate. Are bank-based or market-based financial systems better for promoting long-term economic growth? I think this is the main theme of the topic today. Professor is going to talk about. Some economists have argued the bank-based systems are better at mobilizing savings, identifying good investments, and existing sound corporate control. Others, however, emphasize the advantages of markets in allocating capital, providing risk management tools, and mitigating the problems associated with excessively powerful banks. I'm sure we will be able to witness more evidence on this debate and about all of this in the talk of assessments today. Let me formally introduce the professor in a very brief note because he has a very uh, credentials, this detailed credentials, but I'll be very brief in introducing. Professor Spencer is a retired Deputy Governor of Reserve Bank of New Zealand, and he held senior positions including Head of Financial Stability and Acting Governor of Reserve Bank of New Zealand during his career at the central bank. As Deputy Governor and Head of Financial Stability, Professor oversaw the prudential, regulatory, and supervision functions of the Reserve Bank, as well as macro-prudential policy and bank's financial market operations. It's in fact important for us, especially in the new central bank in that we are uh, going to have separate provisions on macro-prudential policy, which is a new role and responsibility that central bank is going to have in our law. Further, he has also held senior positions at ANZ Banking Group and was ordained to Executive Director of the International Monetary Fund. He chaired the OECD Committee on Financial Markets from 2015 to 2018 and the Financial Markets Working Group of MEAP, an association of 11 East Asia and Pacific central banks. He was a member of the Capital Markets Development Task Force in 2010 and has served as non-executive director of the New Zealand Institute of Economic Research and as a council member for the New Zealand Corporate Treasurers Association. He has obtained a BA Honours in Economics and Information Science from Victoria University of Wellington and has obtained a MSc in Economics and Mathematical Economics from London School of Economics and Political Science. So, without further ado, let me invite Professor Clark to give you a lecture. Thank you.
Thank you, Governor, for that kind introduction, and it's a pleasure for me to be here with you in Sri Lanka. I'd also like to thank my hosts, the New Zealand High Commission, for hosting me here in Colombo. So, we all know that Sri Lanka is in a very difficult economic situation. Um, There have been negative external shocks, and there have also been policy mistakes. Sri Lanka has defaulted on external debt and lost confidence of the international market. So the question is, how do we get back from here? I don't want to spend a lot of time dwelling on the causes, but what is the path forward? That is what I would like to talk about. And I believe there are three key elements to the path forward. The first is restoring confidence in the system by correcting current imbalances and reducing the vulnerability of the financial system to further shocks. So this is about sort of righting the ship. The ship's on a lean. The ship needs to be righted before it can move forward. The second stage is removing the emergency supports and restrictions. And then thirdly, implementing market-based reforms that can give new engines to the Sri Lankan economy to put it back on a sustainable growth path. So I want to talk about each of these three elements in turn. And the first one, that first stage about restoring confidence, I think there are four elements. One is putting the public sector finances on a sustainable footing. Secondly, restructuring the external debt. Third, committing to an independent central bank. And fourth, improving the resilience of the banking system. And I'd like to sort of go through each of those four items in turn. Getting the public finances back on a sustainable footing, I think, is the most important thing to do to restore confidence. That's the most important thing. And the key element of that is reforming the tax system. I think everyone knows the tax system has been allowed to erode over time, and it really needs to be rebuilt. It needs a broad tax base with no exemptions. It should be one rule for all. And the broader you can make the tax base, then you don't have to have very high tax rates. So the key is to have uniform treatment in the tax system. And as we all know, the direct taxes in Sri Lanka in particular need to be restructured and reshaped because there's too much reliance at present on indirect taxes. I might say that, you know, in my experience in the New Zealand in the 1980s, when there were major reforms undertaken, the tax system was totally restructured, and so all of the existing sales taxes and detail taxes were removed and replaced by a simple new tax structure. And that's when our GST, or value-added tax, was first introduced. And that's been a very successful system of having a GST system with no exemptions and a simple direct tax system that doesn't require every individual to have an accountant or a lawyer to do their tax return for them. Individuals, it should be simple enough for individuals to do their own tax return. The second point here is removing subsidies and cheap loans to favoured sectors. That's another thing that was removed in the reforms in New Zealand in the 1980s. On the government expenditure side, clearly it's going to be difficult to contain government spending in the level because of the amount of inflation and the cost of delivering government services. But I think the important thing is to target the most needy. You can't support everyone. You have to target support spending, social security spending, on those that are most needy. And finally, set clear and achievable fiscal objectives. The government needs to set up a medium-term budget and then try and stick to it and give clear reasons for any adjustments to that medium-term path. So that was the first key element, is putting the public finances on a sustainable footing. The second one, as you know, is restructuring the external debt. And there are, agents of the government working to get agreement with the international creditors. And this is very important to get agreement on a haircut of the international creditors, as well as phasing, terming out, pushing out the debt maturities to give Sri Lanka some breathing space in terms of those demands of the debt service, meeting debt service requirements. And also, this is one of the requirements before the IMF program can be finally agreed, because the IMF has learned in the past that there's no point in dispersing new funds if it's just going to disappear to repay existing creditors. Those funds need to be used for current new activity in the Sri Lankan economy, not repaying existing creditors. Now, the third element I think is also important, is the commitment to an independent and accountable central bank to get that legislation through the Parliament. This will help to ensure financial stability and price stability over the long term. I think it's a matter of confidence, because an independent central bank is less likely to monetize fiscal deficits. And the markets know that. So if the legislation's in place, then the international marketplace can recognize that Sri Lanka is serious about not monetizing deficits going forward, which effectively places a discipline on fiscal policy going into the future. And the final element of this initial phase of restoring confidence is around the banking system, because I think there's a lack of confidence, certainly in the international system, in the banking system at present, the domestic banking system, because of the shocks that have been imposed on the banks from the economic disruption. So this is always a difficult one, but I think it's important to try and be transparent. And I think the central bank needs to make a detailed assessment of risks in the banking system, require the banks to undertake stress tests that assume there is going to be, for example, a global recession next year. I think that's highly likely, plus the effects of deregulation, plus the effects of ongoing high interest rates. Okay, interest rates may come back, but they're still going to be high. And these are the sort of things that you need to, that the banking system needs to be able to sustain. And so stress tests internationally have become a normal and the best method of examining banks, getting the results, and then making those results transparent so that the marketplace confidence can be restored. You may recall after the GFC, that's in 2009, the only way that the American authorities can restore confidence in their banking system was through the stress tests. That's when they were first introduced. With the results of those tests, the vulnerable banks and the weakest banks have to be dealt with, potentially through mergers, but they have to restore their health somehow, and the government and central bank need to work on that with the banks themselves. So those actions, I think, will help to restore confidence in the Sri Lankan economy and financial system. Correcting the fiscal imbalance, stabilising the external debt, creating an independent central bank, and ensuring resilience of the banking system. All of those things together will help to reduce the risk premium in Sri Lanka's interest rates, which I think is very present in the interest rate structure at present and in the exchange rate. This confidence would encourage a recovery of remittances and return of capital back into Sri Lanka. And it would encourage the reopening of capital markets. So once confidence can be restored, then the emergency measures can be removed. The short-term emergency restrictions on imports, for example, and capital flows, these can be maybe not necessarily 100% removed, but certainly reduced without causing, major panic or major flows as a result. Secondly, a normalisation of monetary policy settings. There'll be room to ease the monetary policy once that initial confidence has been restored. But it may be necessary to reassess the sustainable level of the exchange rate at that point, given that everything that will have happened up to this nexus, if you like, between maintaining stability and removing the emergency measures. So that brings us on to the third stage, which is the more structural change, the more important changes of getting the economy moving by introducing reforms. And I would favour financial sector deregulation, a market-based monetary policy, public sector reform, and potentially other economic reforms as well to improve the efficiency and future growth of the economy, such as ease of doing business, tariff reductions, foreign investment rules, and land reform. All of these things will make a difference. So I'm not going to talk about the economic reforms, but I will expand a bit more on these financial components of reform. Financial sector deregulation and a market-based monetary policy in particular. So what would financial sector deregulation entail? It would involve move to a more efficient allocation of credit with lending decisions based on commercial criteria. I would promote the development of capital markets as an alternative channel for savings and investment. But that's, in a small country like Sri Lanka, it's never going to be bigger, I would think, than the banking system, like New Zealand. When you have an economy where you mainly have small, medium-sized enterprises, then financial intermediation will generally be through the banking system. Banks are the most efficient form of intermediation in that type of economy. But it's always good to enhance financial intermediation with capital markets, to have a sound and efficient equity market, a debt market, money market, foreign exchange market. So there's work to be done on the markets as well as the banking system. The third point here is removing elements of financial repression. And financial repression is where the government suppresses market-based credit in order to channel savings towards the public sector. So that involves removing statutory reserve requirements, removing interest rate controls, removing preferential lending practices, and stopping central bank financing or automatic financing of fiscal deficits. These are all of things that were implemented in New Zealand when financial deregulation occurred in New Zealand in the 1980s, and in Australia and in a number of other countries. So what does a deregulated banking system look like? There's no interest rate controls, there's no minimum government security requirements or deposit requirements, there's no credit controls or preferential lending. The only restrictions that are left in place are prudential in nature. In other words, they're there to improve the safety of the bank. They're not there to funnel savings towards the public sector. And the prudential ratios that are typically there are liquidity requirements, capital requirements, and potentially also macroprudential restrictions. Now, we're coming on to what I was called a market-based monetary policy. Now, this triangle up on the screen here is called represents Mundell's trilemma. And Mundell was a famous American academic economist who won a Nobel Prize. And his trilemma says that the monetary authorities can choose any two of the three corners of this triangle, but it can't choose three. It can only choose two. And on the three corners are free capital mobility, monetary autonomy, and a fixed exchange rate. Now, if Sri Lanka wants to have a market-based monetary policy, it needs capital mobility, it needs free capital markets, it needs capital to be able to move in and out of the country. So it must have the point at the top. So the market-based policy can either be A or B. You can either have free capital and a fixed exchange rate, or free capital and monetary autonomy. So if you want to control domestic conditions, what I'm saying at the end of it is you need to float the exchange rate. You can't control domestic conditions, have free capital movement, and fix the exchange rate. It doesn't work. And that's why most developed financial systems and monetary policies have a floating exchange rate. Examples where they have a fixed exchange rate, of course, are, say, members of the ECB's range, the euro area. So the countries within the euro area choose not to be able to run their own domestic monetary policy. They choose to effectively fix their exchange rate to the euro, to be part of the euro area, and basically import the monetary policy that's formulated by the ECB in Frankfurt. So it may seem like a big move, but actually, freeing up the exchange rate, we found when we moved from a fixed exchange rate to a floating exchange rate, after it's actually done, it's not such a big deal as you might think it is. And there may be initial volatility, but eventually it settles down. And most countries that have moved to a float, they don't want to move back. In terms of having free capital mobility, you need an open and liquid domestic money market. I know there's a lot of problems there right now, but once you get confidence back in the system, you can return to a more liquid domestic money market that is open to the international markets, and so that the foreign banks and domestic banks will be able to continue to trade with each other financially. There should be a free international movement of portfolio capital through the money market, bond market, and portfolio equity. But it's not to say that there's no restrictions on foreign investment. Most countries will still retain some restrictions on investment in, say, majority stakes in companies and in land, particularly strategic assets of the country. So I'm not suggesting it's totally open, but particularly the financial markets need to be open to the international markets. Just some points elaborating on the floating exchange rate. It should follow the initial financial deregulation. So there's no way you can do that now. You need to do those first setup to get confidence back, then to deregulate the banking system and capital markets, then you can float the currency. You should try to set the equilibrium, set the starting point for the currency somewhere near where the equilibrium is. So it may require some adjustment before you set it free. The major banks will typically become the main price makers for the rupee. You may have training wheels to start where the central bank quotes a wide bid-offer spread, but then eventually takes the training wheels off and lets the banks run the FX market. The currency should be supported with firm domestic monetary conditions, and the authorities need to be willing and realise that some trading in their currency is going to move offshore. It's not going to be all onshore. So the authorities have to be willing to sort of let go of, they're not going to be able to control the currency. They may still be able to intervene or to influence the currency, but not the control that we have today. And finally, the float should be supported with a strong communication strategy. So I said, once you float, then the central bank will have control over short-term interest rates. As it does now, it can do that through the corridor system, through the policy rates that the central bank sets at its policy meetings. There should be liquidity encouraged in the short term, the bills, swaps and bonds market. This should be something that the central bank takes on as one of its responsibilities, not to own the markets, but to support liquidity in those key markets. And I would recommend not using quantitative easing. As you know, this is something that major central banks have been doing in vast quantities since the GFC, and then accelerated with COVID. And now they're having, I think, some of them considerable regrets because it has contributed to the inflation that is now out of control around the world. So the interest rate yield curve, quantitative easing is about trying to control the yield curve, term interest rates, not just short rates. Policy should just focus on short-term interest rates and let the market determine the term rates. Now, very important, we're sitting in the central bank, and we said at the outset that it's important to move towards an independent central bank, and this elaborates on that. A market-based monetary policy should be implemented by an independent central bank that is also accountable. So it has independence in the operation of monetary policy. The targets are still set by the government and the Minister of Finance. But once the government sets the targets, it needs to hand it off to the central bank to get on with the job of independently operating policy to achieve those targets. The single objective should be price stability for the central bank. That it can achieve that over the medium term. If you give it multiple objectives, it cannot achieve multiple objectives, and you may wind up achieving neither price stability or the alternative objective. So the central bank also needs to control its own balance sheet. It needs to be transparent and accountable. So accountability involves monitoring of what the central bank is doing by the public, by the financial markets, by the minister, and by Parliament. So there are lots of checks. So you might have an independent institution, but you need the checks and reporting and questions and answers and ability to make appointments. The government's still going to be making appointments of the governor, of the monetary board, of the governing board, etc. So that's how accountability is achieved. But at the end of the day, the central bank must earn the trust and confidence of the public, the government, and the financial markets. And having an independent, market-based monetary policy and central bank, I think, is the best way of achieving that. Now, just lastly, I mean, public sector reform, I won't go into in great detail, but it's important to stop the subsidies to the SOEs. The SOEs are an important part of the economy. And if they're getting cheap money, they're getting guarantees on their debt, they're getting subsidies, that's very costly for the economy. There's a need to reform SOEs and the financing of SOEs. In New Zealand, you know, there's always this thing, do you privatise the SOEs? And I think you should certainly not consider privatising them straight away. In New Zealand and other countries, it's always best to make it a multiple-step process. Commercialise the operations, get them on a commercial footing, then consider potential privatisation or partial privatisation. And the government should also look to improve the financial control over the permanent government departments. So, in conclusion, I would just return to the same 3 points that I had on my first slide, which is the 3 key elements of returning Sri Lanka to growth is one, restoring confidence, in particular by correcting the public finances, then being able to remove the emergency restrictions, thirdly, then moving to market-based reforms of the financial sector and real economy. Thank you.